And Tiffany, of course, one of the most popular thought exercises on Wall Street at this moment is trying to quantify how much Fed tightening a banking crisis is worth. And when you put together all these factors, the expectations for banks potentially pulling back on lending, how much is that worth in your eyes?
Yeah, well, obviously there's a lot of uncertainty around, a lot of these models that are being created, but ultimately, we think it's very consistent with other work that we've done. We just looked at historically, when does the economy and economic performance really start to deteriorate around hiking cycles? And we looked over 70 years in 14 countries, and it suggested that about 6 to 8 quarters after a central bank starts hiking interest rates, you get a more material deterioration in economic activity. So although we didn't forecast what's going on right now, the specific idiosyncratic issues at some of these banks and the regional banking sector more broadly, I think the timing of it, is really playing out in line with what we have historically experienced. So I would argue this is symptomatic of tight financial conditions. We knew it was coming. We have been saying that we think a modest recession this year is more likely than not. Obviously, the probability of that and even maybe more severe outcomes has increased. We think the Fed probably will be cutting rates by the end of this year.